If you're new to investing, you've probably heard people say things like, that stock is undervalued, or the market hasn't priced this correctly yet. And maybe you nodded along, even though deep down you were thinking, priced correctly. According to who? That question leads to one of the most important ideas in investing: intrinsic value. Intrinsic value sounds intimidating, but it really shouldn't. It's not advanced math, it's not a Wall Street trick, and it's definitely not reserved for professionals. Intrinsic value is simply an attempt to answer one very basic question: what is this business actually worth? In this video, I'm going to show you how to calculate intrinsic value step by step using plain language and simple logic. No hype, no complicated formulas, no assumption that you already know how finance works. If investing has ever felt confusing or overwhelming, this is where clarity starts. Let's step away from stocks for a moment and think about something more familiar. Imagine you're thinking about buying a small coffee shop in your neighborhood. You wouldn't decide what to pay based on how busy it looks on one random afternoon. You'd want to know how much money the shop actually makes, how consistent that income is, and whether it's likely to keep earning money in the future. Stocks work the same way. When you buy a stock, you're buying a small ownership stake in a real business. Intrinsic value is your estimate of what that business is worth based on the money it can produce over time. The stock price is simply what someone is willing to pay today. Intrinsic value is your attempt to understand the business underneath that price. This difference is critical for beginners because it explains why stock prices can jump around wildly, even when nothing meaningful has changed about the company itself. Most new investors focus almost entirely on stock prices. When prices go up, they feel excited and confident, like they're finally doing something right. When prices go down, they feel nervous, discouraged, or even embarrassed, wondering if they made a mistake. This emotional back and forth is incredibly common, especially at the beginning. And it's not because beginners are doing anything wrong, it's because price is the only thing they feel like they can see. The problem is that without understanding intrinsic value, those price movements have no real context. A stock going down feels bad, not because the business is worse, but because there's no clear way to interpret what that price change actually means. It feels random and emotional because, in a way, it is. If you don't have a sense of what a business is worth, you can't tell whether a falling price is a warning sign or an opportunity. You don't know if the market is reacting to something meaningful or just having a bad day. So you're left guessing. You react instead of deciding. And over time, those reactions are often driven by fear rather than understanding. This is where intrinsic value changes everything. Intrinsic value gives you a reference point. It gives you something stable to compare the price against. Instead of asking, why is this stock down today? You can ask, has anything actually changed about what this business is worth? That shift alone can calm a lot of anxiety. It doesn't eliminate risk and it doesn't guarantee good outcomes, but it gives you something solid to think against when emotions start to take over. For beginners especially, that sense of grounding is incredibly powerful. It turns investing from a stressful guessing game into a process you can actually understand and stick with. Before you calculate anything, you need to understand what the company actually does and how it survives in the real world. This doesn't require expert knowledge or deep research. It simply means being able to explain in everyday language how the company makes money and where that money comes from. Who are the customers? What product or service is being sold? Why do people choose this company instead of another one? If you struggle to answer those questions, that's not a failure or a weakness. It's a signal to slow down, step back, and learn more before moving forward. Good investing is not about moving fast or chasing opportunities. It's about making decisions you understand and can stick with over time. Intrinsic value only works when it's built on clarity. Now we get to the core idea behind intrinsic value, and this is the part everything else builds on. A business is worth the money it will produce for its owners in the future. Not the excitement around it, not the headlines, not what people hope it becomes someday, but the actual money it can reasonably generate over time. That idea is the foundation of everything in value investing. You don't need to predict exact numbers or assume perfect growth to work with this. You're not trying to be precise. You just need a reasonable sense of whether the business can keep earning money and whether that earning power is likely to improve, stay stable, or slowly decline as time goes on. For beginners especially, it's important to stay conservative here. Assume growth is modest. Assume there will be competition. Assume there will be bumps along the way and periods where things don't go as planned. This isn't being negative or pessimistic. It's being realistic, and realism protects you from disappointment and emotional decision making. The goal isn't to be impressive or to predict the future perfectly. The goal is to avoid fooling yourself and to build expectations you can live with over the long term. There's one more simple idea to understand, and it's something you already experience in everyday life. Money today is worth more than money in the future. That's because waiting always involves uncertainty. Things can change, plans can fail, and unexpected events can occur that delay or reduce what you eventually receive. When we calculate intrinsic value, we adjust future money back to today's value to reflect that uncertainty and the time you have to wait. A dollar promised years from now is simply not the same as a dollar in your hand today. You don't need to master financial formulas to grasp this idea. Just remember that the further into the future money is expected to arrive, the less certain it becomes and the less valuable it should be treated today. This step is not about being precise or clever. It's about being fair, cautious, and honest with yourself. Intrinsic value rewards discipline far more than cleverness. Here's something beginners rarely hear, but absolutely need to understand if they want to invest with confidence and avoid unnecessary stress. Intrinsic value is not a single number. It's a range. Businesses don't move in straight lines. Growth slows, competition appears, costs rise, industries change. Even strong companies go through periods where things don't go as planned, and no model can capture all of that perfectly ahead of time. Because of this uncertainty, asking what is this stock worth exactly is the wrong question. It suggests a level of precision that simply doesn't exist in the real world. A much better question is whether the current stock price is clearly below, clearly above, or roughly in line with what the business seems to be worth based on reasonable assumptions. That range is important because it gives you breathing room. It gives you margin for error. It allows you to be early, a little wrong, or even temporarily unlucky, and still make good decisions over time. That flexibility is not a weakness. It's the foundation of how real investing actually works. Once you start thinking in terms of intrinsic value, investing begins to feel calmer and more manageable, especially if you're new. You stop reacting to every price move because you finally have a reason not to. A stock going up or down no longer feels like an emergency that demands action. You stop feeling constant pressure to buy, sell, or do something just to feel in control. Instead, your focus shifts. You begin to pay more attention to the actual business behind the stock. You think about how the company makes money, how stable that income is, and whether anything meaningful has truly changed over time. Trends, hype, and short-term noise start to matter less. This is why long-term investors emphasize intrinsic value so much. Not because it's complex or technical, but because it simplifies everything else. It gives structure to your thinking and reduces emotional decision-making. In the end, intrinsic value turns investing from a stressful guessing game into a thoughtful, repeatable process you can stick with. Intrinsic value isn't a trick, and it isn't a shortcut. It's a way of thinking about investing that prioritizes understanding over excitement and patience over urgency. If you're new to investing, this is one of the most important ideas you can learn because it replaces fear with clarity and confusion with structure. It gives you a calm framework to rely on when the market feels loud, emotional, or overwhelming. If this helped you understand intrinsic value more clearly, let me know in the comments, especially if this is your first time hearing it explained this way. And if you want more beginner-friendly investing videos with no hype and no pressure, consider subscribing. We'll keep building these ideas slowly and thoughtfully, one step at a time. You don't need to rush. Learning this takes time, and you're on the right path.